Hi, everyone. My name is Justin Ritter, Program and Events Chair for CBIC, the Charlottesville Business Innovation Council. And here we have today session 2 of the For the Founders series, Start Me Up Right. We're going to take a deep dive look at how to properly organize your startup. And with us today, very glad that we have them, Darden Bell, CPA at Keiter, Senior Tax Manager. And we also have partner Steve Keeler of McGuireWoods here to tell us about how to organize our startup. And with that, I'm going to turn it over to Steve.
Thanks, Justin. Hey, Darden, hope you guys are doing well. And everyone who's listening, hope you're getting through this COVID-19 time period. We're going to hit a pretty basic cocktail party topic range today. People talk about stock options and corporations and LLCs. And what we're going to do, assuming that many of you startup entrepreneurs and service providers understand a lot of the lingo, we're going to hit it from a high practical war story level and frankly just give you a lot of our opinions based on probably 50 to 75 years of collective experience. Pleasure to be here with Justin, who's a great startup lawyer I work with, and Darden Bell and I work on a lot of clients together. So incredible partners for me on this discussion. We can go to the slide that has money talks at the top. Everybody says that VCs prefer C corporations. We're going to talk about C corporation versus LLC, which in our view is the only choice. We can talk about S corps, but lawyers and accountants who talk about anything other than LLCs and S corps arguably are wasting some time and paper. We're also going to talk about Delaware versus Virginia. When I say money talks, venture capital funds and some angels have expressed a preference for C corporations for a long time. Darden and Justin and I understand that. VC funds often have tax-exempt investors who can't invest in flow-through entities. They're planning, there are ways to plan around that. There's a real New York City, Boston, and Silicon Valley preference for C corporation, but our Main Street in Charlottesville to Richmond in 64 tech hub experience is that a lot of great companies with multiple rounds of financing behind them are LLCs. I'll just name a couple in Charlottesville: Apex Clean Energy, SNL, which is now S&P Global, World Strides. I'm sure some of those companies' names are familiar. We often hear a lot about 1202 stock, the tax benefits of an investor being able to sell that. That argues in favor of a C Corp. Some folks believe that C Corps are just simpler because LLCs have operating agreements, tax compliance issues, K-1s that have to be issued to your investors. There's a lot of things that may be considered hassles, but this group, I believe, shares the view that there's real money and return on investment to be won if you seriously consider and run your company as an LLC, when that form is right. I'm going to let Darden in a few minutes talk about what I call fake news, with apologies for that phrase, but there's a lot of literature out there today. Since 2017, the tax rates for corporations are now lower, suggesting that it's now a no-brainer to set up as a C Corp or to convert your LLC to a C Corp strictly for annual tax savings purposes. Darden and I don't tend to agree with that most of the time, and certainly for certain types of clients. For example, clients who actually may be paying dividends and clients that want to reserve their options when they go to sell their company. You often hear me talk about, if you've ever heard me or seen any of my articles, talk about planning without a crystal ball. What I love about LLCs is that you're really putting off the choice of entity until an investor tells you that he, she, or it insists on your being a C Corp. So I tend to set up startup companies as LLCs. We take a wait and see approach. because you can get out of that form into a C Corp relatively painlessly, but the reverse is not the case. Once you're a C Corp, you really are always a C Corp because there's a real tax price for converting. Next slide, please. So we're big fans of LLCs. Just a couple of things on LLCs. I've talked about local companies. We understand that money talks. If VC funds push back, your angel investors or VC funds are insisting that you become a C Corp, listen to your CPA and lawyer, but then make the right business decision. If you need to raise the money and you like that particular source of money, you're certainly going to factor the investor preference into your decision. But the wait and see approach, it's a safe and quick choice to set up as an LLC. If you're already a C Corp, don't worry about it. We can talk about that. But if you are an LLC, I would suggest that you be patient through your angel rounds, talk to your investors. We see companies doing Series A and B rounds as LLCs. And it ultimately may give the opportunity to exit or sell your company for a higher price because of the tax benefits that selling an LLC might bestow on a buyer. I say this is not a plug in this slide, but one of the first questions I ask my clients, if I'm working with a CEO, I ask them, well, who's the company's counsel? And hopefully they'll tell me it's someone of Justin's caliber. And also ask, who's your CPA? And hopefully that's someone of Keiter and Darden Bell's caliber, because one of the easiest ways for me to stay out of trouble is to work with clients that have a really good client advisory team. Next slide, please. A little bit on Delaware and Virginia. Most people who know me, I'm a CPA lawyer, but I take pride in being a practical, sort of common sense type of advisor. I don't really care about Delaware versus Virginia. If I were setting up a startup, I might err on the side of forming a Delaware corporation, even in Charlottesville, because of the sex appeal, the Wall Street acceptance. If you're dealing with strategic partners in Nevada or California or New York, they're familiar with Delaware. It gives your company some cachet. A lot of our clients based in Charlottesville are Virginia entities, either corporations or LLCs. Virginia's got a great statute. The liability board and officer protections are great, almost probably as good as Delaware, but I think it's more of a business cachet decision to form as a Delaware corporation. I would suggest that half of our Charlottesville and or Virginia-based companies are Delaware entities, just because I nudge clients in that direction. However, a lot of clients in Southwest Virginia that are getting grants and or have UVA spinoff heritage behind them, which are very important to them, are Virginia companies, and they want to continue to be, and we love that. Sort of the opposite of a shout out to California. California tends to get its aggressive legislative personality into a lot of different things in business. And most of you know that data privacy and security rules are more easily broken if you're doing business in California. Most of our clients that are online are. California actually has a long arm statute that says even if you're set up in Virginia or Delaware, if most of your shareholders are in California, and that can happen if you raise money in California, certain California rules governing shareholders and directors are going to trump Virginia and Delaware rules. How un-Republican is that? I don't mean that Republican Democrat politically, but a Republican form of government where you assume you're setting up your company in a jurisdiction of your choice. California has a different view, and generally speaking, founders and boards of directors are not treated as fairly in California because the statutes tend to be a little bit more democratic, if you will, and protective of minority shareholders. We do have a lot of folks moving to Charlottesville because it's America's city. It's a biotech hub. who wouldn't want to live here? Look at the view I've got outside my window. Hope you're enjoying it. And you know, it's not uncommon to see California, North Carolina, Arizona entities here because folks have moved here with their companies. So with that, we'll go to the next slide. And unless you guys have any questions, I thought we could kind of turn this into a discussion about focusing more, I think, on the harder decision, LLC versus corporation, and get the perspective of my friend Darden.
Can I ask a quick question before jumping into Darden's discussion? Steve, if I were a founder, can you tell me about costs? Is it cheaper to start up as an LLC? Is there a charter fee for the number of units that I issue through an LLC, or is it more expensive to file as a C Corp, depending on the shares that are issued?
Right. I think you may know the answer to that. It sounds like a loaded question. I may not, because I rely on paralegals. I do know I just set up an LLC yesterday so that I could invest in a company that really needed help. It was more for the cause than the investment opportunity. And it was $100 to set up the LLC and file the articles in Virginia. I actually set up Virginia. So there you go. Didn't take my own advice. So in Delaware and Virginia, your capital and number of authorized shares drives your annual registration fees. But in my experience, I've never had clients complain about the relative cost of Delaware versus Virginia. And please let me know what you know, Justin. What I have found is that some companies will reduce their authorized shares to save a couple $1,000 a year.
Yes.
So I don't have those numbers off the top of my head. My guess is that Delaware could be a little more expensive. Do you know otherwise?
It is. There's also a franchise fee that's just, it's not tied to your number of authorized shares, I believe. And so you're dealing with a franchise tax. I believe that the charter schedule is more expensive than Virginia corporations. But you know, I think that it's safe to say that an LLC in pretty much all instances will be cheaper to maintain as far as paying the state to be registered than a corporation. So just something to think about in the beginning.
It's interesting. Just one quick aside. The traditional articles and books about LLCs and corps always suggested that corps are more expensive and costly to set up. We don't see that. Our fees are roughly the same. I think tax compliance and the need for Darden on an annual basis or your accountant can be higher. Let Darden speak to that, but we don't see material cost and expense differences in this entity choice. We think it's driven mostly by taxes and what the money your investors request.
Thank you. With that, Darden, can you take it away?
Sure. Yes, I just want to say, first off, thank you guys for including me in this. This is a great honor. I'm happy to be here and part of the CBIC series. So look forward to giving some Keiter and personal perspective as it relates to the differences between C Corps and partnerships or LLCs. And, you know, Steve already alluded to a couple of those factors earlier in this chat, and that was complexity versus flexibility. And, you know, that's what partnerships are really known for, is their flexibility. And along with that, though, does come some complexity. So from a tax perspective, there's a variety of different factors that you should really be considering. And it's not just the return on investment for your investors on the bottom line, though that is a very important one, obviously, but it's also just the annual tax compliance, the tax returns that have to be filed, the impact on your investors' tax returns. You know, for example, if it's a partnership or an LLC, that's a flow-through entity. So any activity from that gets reported on a K-1 to those investors, and then it complicates their personal income tax situation more so than if they're just holding shares in a C corporation, in which case the only real impact on them personally is whether or not they sell the shares or they receive dividends that they would have to report. But on that note, that's actually can be a really good thing for investors, especially for startup companies who typically generate losses in the early years. Being that partnerships and LLCs are flow-through entities, those losses do make it through to the individual investors' income tax returns. And depending on their personal tax factors and whether or not they're active or passive in the business, they very well may be able to use those losses to offset other sources of income. Whereas if you're a startup company in a C Corp form, those losses get trapped at the entity level, and the investors get no personal benefit from those losses. Those losses basically just build up at the corporate level and will carry forward until the corporation generates income to then use those in the future. But from a founder's point of view, from a startup point of view, we tend to prefer LLCs because of the flexibility I referenced earlier. In LLCs and partnerships, you can have a variety of classes of stock. You can really structure your capital stack however fits the economic deal that you have in front of you and what your investors want to agree with, whether it's common and preferred units, profit units. You can have preferred returns involved. You can really do a variety of things that can help satisfy everyone's economic needs in the deal to get a startup business off the ground. Corporations tend to be a little bit more rigid. Yes, C corporations can have different classes of stock, but they are more rigid as far as moving assets around and how you form whether assets have liabilities attached to them and the impact on that. If you ever wanted to spin off or split up the company, there's definite tax implications, negative typically tax implications to C corporations in that regard, whereas partnerships have the ability to move assets in and out, usually tax-free. And then, another thing that really benefits founders in a startup sense within LLC context is the ability to revalue the company's equity and assets. I don't want to get too tax technical on this chat, but for any of you who may have heard of a revaluation or 704B revaluation, that's basically the company choosing to revalue everything on its balance sheet to full fair market value, which includes the founders' units and the assets or IP that the founders may have contributed to the entity. So doing those revaluations allows everyone to really stay on a level playing field economically, and that allows for allocations of activity and cash flows from future distributions to be allocated more economically as well. That being said, what I just referenced is rather complex from a tax compliance perspective when you actually do the company's tax return. Whenever you get into that world, you should expect your tax compliance costs on an annual basis to increase significantly because of all of the calculations that are required, not only at the time of revaluation, but annually moving forward. Pros and cons. You don't have to dive into the complex end of the pool as far as partnerships are concerned. But if you want that flexibility or you want to take advantage of what partnerships allow for you, then it's there. Just know that if you do that, it does tend to get a little bit more costly. C corporations tax returns are complex as well, but they are more boilerplate complex, and there's not a whole lot of variation unless you're starting to get into a whole lot of states, right? There's that's one of the big reasons why VCs actually prefer C Corps is the tax compliance side of things, right? It's, yes, Steve referenced earlier the fact that they might have institutional or nonprofit investors, and that's definitely a factor, but it's also the factor of not having to wait on K1s from a partnership or not having to deal with 704B revaluations or all of the complex, subchapter K partnership items that could come into play. And also it just really helps them know what they're getting into and not be surprised down the road, because that's one other really important thing that, Steve alluded to earlier is if you are going to consider the LLC partnership context, then you really need to make sure you have quality advisors by your side. I've been doing this for well over a decade now, and I can't tell you how many times I've run into situations where people did not fully understand what they were doing. When I say people, I should say tax preparers, other professionals
Lawyers.
in the industry, lawyers. But I don't like throwing people under the bus. So I don't want to say too much. But the point is that you really need to have quality advisors by your side who know what they're doing and can walk you through this. And that's not just as you get down the road, but that's from inception. One of the most important things to do is to actually get your CPA involved with your lawyers at the outset in drafting of the operating agreements, so that everyone understands what the provisions in the operating agreements really say and what they mean from allocations of activity and cash flow perspective. You should really have all of those operating agreement provisions modeled out to, using a hypothetical scenario to really see what the impact would be, not only on the founders, but also on the investors, to make sure everybody really knows what they're getting into. Far too often, high-powered CPAs aren't brought in until years down the road, and things weren't necessarily handled the way they should have been in the first couple of years. But now, the company's dug itself a hole that's really hard to get out of and very costly to get out of. And I've even seen some where they've taken it all the way to the end of the road, where it's time to sell to a PE fund or a VC, or even potentially go public from an LLC context. But because allocations and the operating agreement was not followed the way it should have been, you end up in a big legal battle at the end of the day between who really gets what. And nobody wants that. That's really can generate some bad blood between the company and its investors. And it's better to avoid all of that and just do it right from the outset, which is why you need quality advisors on both the legal and the tax side. So I want to touch now a little bit on the tax rates, right? Steve alluded to some literature that's been really prevalent since the Tax Cuts and Jobs Act was passed at the end of 2017 that permanently lowered the C Corp tax rate to 21%. And that's a great win for C corporations. There's no arguing about that. But what people can't forget is that there's still a double layer of taxation on C corporations. The company is still paying 21% plus whatever state rates it's paying. And then investors are also still paying tax on the dividends it receives, right? In a partnership context, because their flow through, it's only single layer of taxation. And whatever the tax rate in that situation is dictated by the investors who are receiving the activity on their K-1s. Another part of that Tax Cuts and Jobs Act was the qualified business income deduction, or you may have heard of it referred to as the 199A deduction, which is 20% of qualified business income. And that deduction was put into place to try to level the playing field between corporations and partnerships when they dropped the C Corp rate. And it really did level the playing field, and in some ways actually made it more beneficial for partnerships who qualify for that deduction. And this is going back to the point I just made a minute ago. It's really critical to model everything out, because no fact pattern, there's not one fact pattern that fits every company, right? Every company's situation is completely different, whether they qualify for deduction A over here or credit B over here. Every single situation is different. So it's a very bad idea to lay a blanket statement and just say, oh, C Corps are better because the tax rate's lower. It's really important to get professionals involved to understand what factors are at play in your situation and to model out what the impact is. And I can tell you firsthand that many of my biggest clients who are qualifying fully for the 199A deduction are actually coming out ahead by remaining partnerships than if they had gone to be C Corps. So just let me clarify that point. They're getting the full 20% qualified business income deduction. They're making distributions out of their business to their investors and their founders, which is, provides cash flow for them. And those distributions are not taxed as dividends coming out of a partnership as they would be if they were coming out of a C corporation. So when you add the whole scheme together with cash flow to the investors and everything, companies and partnerships who are making significant distributions to their investors and founders and also qualify for this qualified business income deduction still come out ahead by being partnerships than if they were C corporations. And I have numerous models to prove that. Now, that's a specific fact pattern. And like I said a minute ago, every fact pattern is different. So it's really critical that you get your professionals involved and model it out. But I can assure you that there's no way it is an accurate statement to say that C Corps are better than partnerships across the board now just because this federal rate has been dropped to 21%. So, there's a lot to be, considered here as it relates to the fact patterns and whether or not you should be a partnership or a C corporation. And I've taken.
So, Darden.
Oh, yes, sir.
So, my practical experience has been that there is baggage that goes along with being an LLC, organizational, like annual tax compliance, cost, expense, etc. But, I've never in my 35-year career, I've been through the 2001 and 2008 crises, and now we're in another one. I've never had a moment where I've said, gosh, I'm glad my client is a C Corp, because clients don't do mergers with public companies that often. My clients don't go public that often or ever. My clients sell for hopefully a nice sum of money well before they do a C and D round of preferred stock. So I think what we're saying is, especially in the early years when flexibility is king, what do you really lose by being an LLC? I had a couple of recent stories. One, biotech company converted to a C Corp 2 years ago because the North Carolina VC Angel Group insisted that they be a C Corp. So we did that. Another client, profitable client locally, was an S Corporation. A local angel wanted to invest $6 million. So that's, feels like a Series A round. But guess what? He preferred an LLC structure. And of course, he could not invest in an S Corp. So we actually dropped the assets of this S Corp company into an LLC, brought him into an LLC. My disappointing third story and last one is large venture capital backed company had done 5 or 6 preferred rounds, recently elected to check the box to be treated as a C Corp for tax purposes, even though we'll continue to be an LLC for legal purposes, which is a cool way to become a C Corp. And I recommended, that they think about it seriously and against it. And this was a company, they made a good business decision for them that did not anticipate paying dividends in the near future, but they really had gotten tired of the annual tax distributions. They're profitable, and the K-1 complaints from investors. So Darden and I think, Justin, we're absolutely aware of the cost paranoia, the complexity and the intricacies of LLCs, because business owners don't have time for excessive legal and tax analysis. They need to run their companies. But I think the takeaway for us has been flexibility means everything. If a buyer shows up and says, we insist on buying assets, we refuse to buy your equity, or they say, we want this platform of your company, but we don't want this part of your company, it's a lot easier to get a deal done if you're an LLC, because you can split off unwanted assets, you can sell equity or assets with the same treatment. So again, my experience has been, wow, I'm so glad the client is an LLC when the unanticipated happens. That flexibility, I think Darden and I look back and say, Mr. or Mrs. CEO, you've been complaining about this for 10 years, but aren't you glad we stayed the course? Because you're going to get X dollars more when you sell, and or we can get a deal done that we probably could not have gotten done as a C Corp. So maybe an overstatement, maybe an exaggeration, but that's been our experience.
Absolutely. Yeah. No, flexibility is the number one reason to be a partnership or an LLC, you know. And when you're starting out, you do not want to cut yourself off at the knees and force yourself into this one box of being a C corporation for the duration of your history. You want to maintain that flexibility because you don't know what the future holds. You don't know if you're going to want to give a key employee a share of the pie down the road. You don't know if, as Steve mentioned, you're going to get to an asset sale. You don't know if you're going to spin off, split up, merge.
Or what if you don't, what if you cannot sell your company like a lot of life science companies in the bio hub of Charlottesville? What if the only exit is a license of your technology to a strategic partner where you've got royalties coming in for 15 years to a C corporation, and those are double taxed to pay them out to your loyal investor? That's a tough one to do.
It's a bad answer.
Yeah.
Yeah, definitely a bad answer when you could easily just flow them through a partnership and have it taxed once. Definitely a bad answer there too. So, between Steve and I, we can give you hundreds of horror stories of, what being a C corporation meant to one of our clients. To be fair, there's some horror stories out there of being partnerships as well. So by no means are we saying partnerships are perfect, but I think it's safe to say that we've heard far less horror stories from the partnership side of things than the C Corp side of things. And a lot of that has to do with the flexibility that partnerships provide. And on that note, I compiled a little list of the most important factors I think founders should be considering in choosing between partnerships and C corporations up front. First and foremost, like we just talked about, is that flexibility and what you're going to be able to accomplish moving forward. You can always convert to a C Corp from an LLC if you want to, but you can never go to an LLC or partnership context from a C Corp without tax consequences anyway. So flexibility is number one, and that's clearly a win for the partnership arena. Number two is after-tax return on investment for the investors. And every fact pattern is different, but from my own experience, if it is a business that's qualifying for the Section 199A deduction, it's usually a win for the partnership context because it's still single layer of taxation rather than double layer of taxation that a C Corp is going to require, right? Three, simplicity. Yes. Oh, sorry.
Yeah.
That was a question. Three is, simplicity versus complexity as it relates to administration and compliance with tax returns, tax reporting, K-1s for investors. Usually that's actually going to be a win for the corporations because you don't have all of your investors banging down your door. Hey, where's my K-1? I need that to file my tax return. And also, the complexities that come along with the revaluation side of the table. If you ever go in that direction with the partnership, the complexity of the compliance can definitely be somewhat of a burden if you're a partnership, in which case C corporations typically would be more favorable in that context. However, I do want to say that in the early years of an entity, you're typically not into those deep, complex waters just yet. So there's always a path where you could be a LLC or partnership for the first few years while things still remain relatively simple, get those losses flowing out to the individual investors so that they can use those themselves and then always convert to a corporation later if that's what you prefer to do. So, definitely things to keep in mind. Another thing is, the ability to find and or afford appropriate legal and tax representation. Like I said before, there's really not that many people that you can really consider top-notch in the partnership tax arena. I don't want to speak for the legal arena. I'll defer that to Steve and Justin, but from a tax perspective, I can tell you that there's just few and far between are you going to find people that are able to interpret those operating agreements, handle those allocation provisions appropriately, deal with target capital account allocations, things like that. So making sure that you have adequate representation is another thing. C Corps tend to be more straightforward, so it's somewhat easier to find representation for that side of the table. And then the last thing, and it might seem, out of place to be thinking about this now at the outset, founding your business, but you really should be considering what's the runway and what's the runway of your business, and when could you be considering a potential sale or exit, right? Because exit is going to make a big difference to whether or not you should be a C, or it's more beneficial anyway to be a C corporation versus a partnership. And again, it kind of depends on the fact pattern, but based on all of the examples Steve was mentioning a minute ago, and the horror stories that we've commiserated around, we can assure you right now that the majority of the time it's more favorable to be a partnership or an LLC when it comes time to exit.
Another real life story, and then I'll ask Justin how much time we have. But when we are called by a client CEO, let's assume Justin, you own a company and you call me and say, we've gotten an offer we cannot refuse. We want to sell the company, and they're sending us a letter of intent. And Darden and I will react. Is it a stock deal? Is it an asset deal? What's the purchase price? Is it all cash? Is it deferred cash? And what I love about you reminding me that you haven't liked it, but you're an LLC, is that in the day of the innovation economy, technology companies generally have very few hard assets. They've got a lot of goodwill, but guess what else they have? They have 100 customer contracts that cannot be assigned without the customer's consent. Guess what? Selling equity or stock in a corporation or an LLC is a lot easier. Buyers don't like it because of successor liability, which I think is overrated, that fear. They also don't, but sellers don't like to sell assets out of a C corporation because of double tax. Long-winded way of saying, if you're an LLC, we can sell equity in the LLC, the shares, if you will, or units. We don't have to worry about assignments of intellectual property, assignments of 1,500 customer contracts or SaaS contracts, and the buyer can treat the transaction as an asset purchase for tax purposes and get a stepped up basis. And guess what? The buyer should, in theory, pay more for your company if it can reduce its after-tax cost by stepping up the basis of the assets. So the best of every world is selling the equity in an LLC. If Darden is a CEO, Justin is a CEO and he is approached by a buyer and he's got a technology company. How much time do we have, gentlemen?
I think that we should keep going until you're comfortable that you've
Okay.
hit all your points. And if anyone out there is needs a break, hit pause, and we'll be here when you get back.
Okay, terrific. So Darden, maybe we can come back to you in a moment.
Sure.
If we could go to the slide with what's in a name at the top.
This one. Here we go.
There you go. I'm going to skip over trademark your name and logo. It seems so simple. Don't worry about saving a couple of grand not to do that. Just do it. Get your domain name set up. In this economy, of course, your name, your brand are everything. But let's talk about cap tables, guys. I am so much more expensive than I need to be when my clients don't do a good job of keeping their file cabinets or their file folders straight at their companies. There's two extremes in using lawyers and accountants. The one extreme is LegalZoom. Go online, do all of your own legal work. I'm certainly not going to pay Steve Keeler and McGuireWoods or even Justin Ritter their hourly rate or a retainer to handle stuff that I can pretty much do on my own online. Well, obviously, there are footfalls to be somewhat afraid of. Investors get nervous if you haven't paid lawyers and accountants. Justin and I think, are probably more proactive than most lawyers anyway, because we're in a tech-oriented hub with entrepreneurs. We write off a lot of fees and we spend a lot of free time. And it's our pleasure to do that. we're not VC investors, but if we can do the right thing for 10 companies, one of them is going to pay us well on an exit. So don't be afraid to call lawyers and accountants. Don't bother Darden until after tax season. He's pretty busy. But the cap table, keep a list of your shareholders. Get the share numbers right. Keep a list of your option holders. If you promised your CFO or HR person options and you put it on a dinner napkin at the C&O restaurant before quarantine, put it in an agreement. It shouldn't just be a handshake. If people leave and memories fail, it's amazing how often we have to clean a company up. And our fees don't really get ramped up due to the value add planning that we do. It's typically the due diligence and the cleanup. Sorry, Steve, we can't find those stock certificates. Sorry, Steve, we didn't file those amended articles, so we sold Series B, but we never filed the charter. Write this down, guys. Tracy Green, Justin, and others in this community know this, but Carta.com. Carta.com is an online service that I have no investment in. I get no value from other than if my clients use it, it handles your cap table, which can have 25 investors on it, right? 3 founders, option holders. These Excel spreadsheets get pretty complicated when you're raising capital at $10,000 a pop. But Carta.com lets you, the entrepreneur or your HR and CFO folks, clean up your cap table, keep it current, do annual valuations. 409A valuations are not only important when you're issuing stock options, and they're not that expensive, but Darden needs them and can use them if you're an LLC and you're doing annual valuations for tax compliance purposes. Equity plans. You've got to have an equity plan. So let us handle tax planning, employment law planning, securities law compliance, but keep your house in order so that we don't get more expensive than we have to be begging you for company information and accurate information, because we want to be cheaper and more value add. To the next slide, I love the topic of dividing the pie, and I think we've got an article that my partner Claire Lewis and I did that can be made available. But dividing the pie is a conversation. If Justin, again, you're my CEO client, you come to me, you tell me that you and Darden are attached at the hip, you're brothers, philosophically and in every way. You trust each other impeccably. You have a third partner who is always at the Outer Banks, but he's valuable. When I think about how you divide the pie of a company, I just want everybody to consider how much value you can get out of planning ahead, to go back to Darden's point. And that is, the founders need to be real with each other. I know it's not romantic to have a settlement agreement or a prenuptial agreement with your wife. I don't have one. I wasn't brave enough to request one when I got married, but it a prenup with your founders, especially if you're good friends, especially if you trust each other, is important in that if we're all in this together, you're going to put in 60% of your time. I'm putting in 100% until you leave your last job. And the guy at the Outer Banks is going to put in 20%. Can we have an honest conversation about what each of us is putting in now, what each of us expects to do in the next year to 2 years as we move toward the Series A, which is a topic Justin is going to bring to you in a future session. But what I like about doing a prenuptial agreement, a founder agreement with vesting, what that means is if Darden comes to us and says he's having health problems or he's bored silly and he wants to pursue his goal of being a rock band leader, if Justin and I are his friends, we're going to let him go with a handshake, but he shouldn't be able to keep all of his stock, right? If that happens in a year or 2 years. So we really encourage, we don't do this often enough. I'm going to be really honest with you. I'm an honest lawyer, very unusual. I'm amazed how seldom I convince founders, a group of founders, or even a strong CEO and 2 key people to enter into a shareholders agreement before they start bringing on angel money and have an honest, not personal discussion about what should each of us get. It might not be 33 1/3%, guys. Let's have that conversation. And also, what happens if Darden changes his mind and wants to leave? Because we do have a lot of war stories about former CEOs, even who leave disgruntled, and the people that are left behind are not happy about it. She continues to own 35% of the company. She's living at the beach, or he's living at the beach. He's a CFO that left. Try to think ahead about the mechanisms that should be built in to keep the team happy, to keep morale high. These are not legal issues, they're people and business issues. So when you're dividing the pie, you've got the current pie to divide one way or 2 or 3 ways. We have a lot of clients, interestingly, that don't give up any equity. They just overpay. They give their employees parking, great health insurance, and a lot of other goodies, and they don't give away equity. I'm a real believer in sharing equity. I think most venture-backed companies are as well. But those 3 categories of folks are the founders. Helpers would be key people, C-suite people that might get profits, interest, or actual stock. The second tier, third tier helpers might be developers, even 5 to 10 people or more that are getting stock options. So what I love about setting these terms and doing it right as we go, feels a little more expensive, but you do your founder agreement right, you do your stock options right. Justin knows how to get you to the right people in the right forms. So use a lawyer. Your in-house counsel may be qualified. But what I love about putting a lot in writing early is that when the investors come on, you can say, hey, we've done that. No, we're not going to agree to 5-year vesting. We've already got our vesting negotiated. It's a lot easier to negotiate with the Series A on a strong foundation when the 3 of us have already agreed to 3-year vesting of our equity. If the Series A comes in and you say, we don't have any agreements because we're brothers in arms and we trust each other, we don't have anything in writing, trust me, they're going to take advantage of it. They're going to set your vesting then. They're going to tell you you're going to lose half your equity if you leave the company. So there are things that we can all talk about, bargain stock options and how to structure stock options. If you are at a cocktail party and you hear about founder stock, don't be misled. You know, we think that being a heavyweight founder who wants special voting rights and convertible founder stock, it's protective of you as the founder, but it might make money harder to raise later. So learn what you can in sessions like this and from your advisors. Go to the stock options slide, the next slide. This is an area where Justin and Darden can jump in with questions. So dividing the pie, founder equity, which is really sweat equity. You can grant options to your employees. You can grant equity to your employees. That's taxable. You can do some tax planning with an 83B election. Let's not get into that today. Only with an LLC can you do profits interest. And would everybody on the mall listen to me when I say this? Profits interest are stock. Profits interest are equity. If you have a profits interest in an LLC, you can tell your friends, if you're not breaching your confidentiality agreement with your company, that you're a partner, that you're a stockholder in the company. People seem to think that profits interest are kind of a less attractive economic deal. They're not real equity because of that name. A profits interest is nothing more than stock in an LLC that, here's the good news, is not taxable to you when you get it. And the reason it's called a profits interest is that it doesn't have current value, but it will accrue value in the future, just like an option that you get with a current fair market value price. So an option is not in the money, just like a stock option is not in the money. So don't be afraid of profits interest. Don't be afraid of LLCs. You guys are smart. You're entrepreneurs, CEOs. You can figure this stuff out and listen to the advice of folks like us when we say you should consider an LLC. You should pay a little extra money to sign up for Carden.com and get a 409A valuation. You should pay a real accountant. I would rather you have a boutique firm like Justin's as a law firm than my law firm and a good accounting firm like Keiter. Then you're hiring me as a lawyer and having an accountant who is a great advisor, has been loyal to a company. But I've had accountants tell me recently, Steve, I've told my client this, but I'm just not that comfortable working with companies that have all this preferred stock outstanding and stock options. Well, if you're not, it's time to use you for the bookkeeping and to go see another accounting firm to do the tax plan. Let's go to the next slide. So I want to talk a little bit. This is foreshadowing an advertisement for Justin, Tracy, and CBIC, and India, Brahm, and all the great people at CBIC who are putting this series on. And I love the dividing the pie. When we get to the point where we've actually got interested local angels, family offices, which are one of my favorite sources of capital, particularly in tough times where you need patient money and people who love to make impact investments in renewable energy companies doing COVID-19 oriented products and solutions, companies that are having a dramatic impact on the whole world. Family law offices, foundations, universities love impact investments. So I think we are going to see a time where venture capital is going to be harder to raise in some ways, but maybe easier and more meaningful to raise in other ways. Next 2 quarters will be tough. I think I alluded to this, maybe inappropriately or unseemingly, but I invested in a company yesterday because it was the right thing to do. I think a lot of people are going to do that. Series B's and C's are going to be hard to close because they're driven by investors who are distracted by a lot of babies that they need to babysit right now. But raising angel money and maybe even doing a Series A is not going to be impossible in the next month. We're getting them done. So angels and Series A investors, which Justin will do a future series on this, but part of the pie splitting right is founders, keep helpers, and then the angels in the Series A. And you guys know the lingo, but as you work through convertible notes and safes, which is a cheap way to bring on family money or dumb angel money, although it's popular in the Silicon Valley, a lot of smart, rich people. One of my favorite definitions of venture capital is just essentially it's money that an investor is willing to lose or can afford to lose. It's a lottery ticket. So a lot of angel investors are willing to make investments in convertible notes and safes because the parties don't agree to value. So CEO thinks the company's worth 20 million. The investor laughs and says, you're not worth 5 to 10 million. So let's just do a convertible note or safe offering. The reason I want to bring that up in this context is Darden and I are going to care about what you're giving to the investors because it's going to have an impact on our annual tax planning and compliance. When you issue a note or a safe, it's typically not a taxable event. But I want to know from a business perspective, and Justin's all over this in his practice, he wants to know, well, what are the business terms? How do the notes convert in the future? Do they convert at a 20% discount off your next round? Is there a valuation cap? So you see that a lot these days, more aggressive investor planning. So are you issuing debt to kind of put off the valuation argument? Or are you doing a priced round and issuing preferred or common equity? Because when you go to do the annual tax compliance, Darden, Keiter, or your CPA, they need to understand and have your cap table. They need to know that notes were converted last November. They need to know that options were exercised by 2 of your executives in December. They need to know that you granted profits interest in an LLC. So there are business reasons for deciding between safes, simple agreements for equity or convertible notes. There are business reasons for doing seed preferred, one of my favorites. It's funny to me that everybody talks about Series A, B, and C. There's no legal reason to label around C or AA or A1 or Series A. What we're finding is a lot of companies raise 10 million or more before they even do a Series A. It's amazing. We're seeing a lot longer periods of seed, loyal angels, funding companies. I think Series A usually connotes your first fund round with a commercial institutional investor. But I think it's important to know that gone are the days 5-10 years ago when you raised $2 or $3 million before your Series A round. Most of my clients are raising 10, and I'll say $15 million before they start to think about a Series A. A lot of those angels come in as common equity holders. A lot of them come in as preferred. Most of you know the only difference is the preferred gets their money back first. They're first in that stack, that waterfall. So put in a plug for CBIC, Tracy, India, and Justin. The future sessions will talk about attracting venture capital, structuring it, but it's critically important for today's discussion because as you form and grow a company, you've got to keep your lawyer, excuse me, and your CPAs apprised of what the heck it is that you're doing. Because these steps in building the pie, slicing it, and serving it to these different stakeholders, each of those steps will have future tax implications that you've just got to let your CPA and lawyer know about. Go to the lawyer and CPA slide. Darden, you've talked a little bit about, this is kind of a trick question, but you've talked a little or a lot about the importance of consulting us. I want you guys to think a little bit about your 1 or 2 best questions, and maybe for you, Darden, a takeaway. But as you'll see on my lawyer and CPA, because I got an accounting degree before law school and I was smart enough to realize that I wasn't smart enough to be an accountant, I also wanted to continue to be a pretty social individual. So I put off real work and I went to law school. So I added a law degree to my accounting degree. I love the fact that I come at businesses with sort of an appreciation for, my apologies, for accounting. But you know what having an accounting degree really teaches me? It teaches me the importance, again, of asking the client, you have an accountant that you trust, that you understand. One of the themes that we run into beyond being comfortable with the type of entity and being comfortable with the structures that Justin sets up as a startup company lawyer as you raise capital is state and local tax. I mean, a lot of companies with 5 employees and SaaS platforms or biotech companies have business or customer relationships in other states. The ramifications of that can be different for LLCs and corporations. So what we find is that a lot of small firm accountants who are absolutely the best at what they do tend to start getting out a little bit over their skis if a company has investors in different states, customers in different states, state and local tax issues, not just income, sales taxes. trust me, it was a surprise to law firms years ago when we realized we might be exposed to sales taxes. But so the world is complex. The world is flat. And what we're finding is every company is a technology company. Every company has international potential. Every company crosses the Virginia border into North Carolina or Maryland. A lot of companies do business in California. Of course they do. And what we find is it's really a bad day for a company when you're going out for your Series A and the Series A investors law firm says, we've gone into the data room, we've done due diligence on your company, and we have the following 25 issues that we need you to fix and clean up before we'll invest in your company. And what happens is you've got a $50,000 legal bill and probably another $25,000 in accounting fees to clean the company up when you might have spent $5,000, $10,000, $15,000 3 years ago, 2 years ago, 1 year ago to avoid the cleanup. So we know you hate the boring legal stuff, the tax stuff, and we love this stuff. How geeky are we, right? Darden and Justin. But what we love about it is we see the world through our clients' eyes. We're excited about what you, the entrepreneurs, are accomplishing, what you're doing for your community, your employees, your investors, world-changing technologies. And we take it very seriously that we want to not only protect the founders, but maximize the return, maximize the sales price, minimize the dilution in your ownership because you've done things right, you've crossed the T's. We don't want you to throw good money at overpriced professionals, but we want to help you learn how to spend smart money efficiently. And frankly, having the right advisors around you is critical. I had a client the other day. Lawyers are bad news, folks. We're jealous of CPAs because Darden gets phone calls once a quarter, once a year. Lawyers only get calls when something bad has happened or it's going to be a life event, like an equity raise. Something bad happening would be an employee just sued us, or we think somebody might be stealing our intellectual property. We don't get that annual annuity, the audit, the tax return work. And, I think you need to appreciate, this was music to my ears, clients who say thank you to us. I don't know why I'm asking this audience for caring and feeling, but we're people and we care about our clients. And it's such a pleasure to work with entrepreneurs, people that are taking risks. And we like to share that risk and to give value. Client the other day said, somebody on the phone the other day, we were talking with a group of potential investors, and it was great to be able to tell them that we used this particular law firm and that we had this particular accounting firm because it makes those investors and third parties comfortable, right? I'd also encourage companies to have more than one of some of these. Justin and I work on clients that might use Justin more frequently. There are multiple clients in some of these big events, right? There's a board of directors, there's a CEO. I'm frankly, it's my pleasure when I have an opportunity to hire Justin to represent a CEO in a deal where a company is getting ready to do a transaction because the stakes are different, the risks are different for a different group of people. So a rambling way of saying, lawyers and CPAs, the right and left hand, you deserve free time, you deserve value add fees, value add services, you deserve responsiveness, Saturday responses, nighttime responses, big attention during tax season, lots of attention if you're trying to raise money or sell a company. We work hard. You also deserve that the left and right hand are talking to each other. And you deserve an accountant who understands Justin's operating agreement or Justin's certificate of incorporation and bylaws and stockholders agreement. We understand what Darden does. Darden understands what we do. That saves a lot of time and money. I think you all know that I'm going to kind of top it up here. Don't grant stock and stock options without committing to it in a legal agreement. It doesn't have to be overly complicated. And understanding the tax ramifications. Understand what preferred stock is before you agree to a term sheet. Don't grant warrants to an investor who wants a little sizzle on top of her convertible note preferred equity without talking to Justin or understanding how warrants work. If you make stock award to employees, understand the difference between stock and options and profit centers. So I hope everyone will accept my apologies for rambling, but I'm going to throw it back over to Justin, our moderator, and maybe have him ask a couple more questions, and then Darden, maybe you can share a couple of war stories or takeaways and wrap this one up.
Steve, much appreciated. Thank you so much. So I've just jotted down a few notes with the mindset of if I were a founder, what questions would I have pertinent to this discussion? So just a few. Let's say I was a founder who hasn't quit my day job yet, and I'm burning the candle at both ends, and I have a startup out of my garage. I'm working nights and weekends, and I'm a W-2 employee at my current employer. With my current employer, Darden, when you mentioned that with a partnership, net operating losses could pass through to me, the founder, at the inception of the entity, is it possible that those net operating losses could credit or apply against my W-2 income?
Yes, definitely. So the situation you just described, it sounds like there's a sole proprietor. There's not much else to it yet as far as employees or anything else going on just yet. We're still at the very early stages. A lot of times in those situations, the best thing to do would just be to form a LLC to legally wrap your endeavor in to protect you personally from some legal liability. But from a tax perspective, you would actually file that on your Schedule C of your personal income tax return, assuming that at this point you are the sole owner of this LLC. So in that case, whatever you report on your Schedule C of your personal return would net against everything else that you've got going on in your world as far as income is concerned. So if that business had generated net losses, then yes, it can definitely flow through and offset other sources of income that you personally hold. Okay.
And so that would be the same consequence for if it was a 50-50 partnership or LLC taxed as a partnership, me and my brother, say, in the garage example.
Yes, it would. The answer would still be the same, provided that you were able to meet the material participation tests of the LLC, and likely you would, but because you're a W-2 employee of another company, it is going to be a little tougher for you to meet those tests, especially because there's somebody else who's also contributing man hours to the LLC activity itself. Okay, cool.
Next, so again, hypothetical founder hat on. I've heard, and I'm trying to choose between an LLC or C Corp. I've heard that one of the benefits of being a C Corp is that there's a potential for a Section 1202 small business gain exclusion. And I understand the holding period. I Googled that. I saw that the holding period is 5 years that you have to hold your shares. In your practice, how often do you actually see the 1202 gain exclusion being used. Yeah, maybe let's just start with that. Steve, welcome back.
Sorry, I lost power.
No worries. We just finished one question, going to a second one, which is essentially, I'll restate it. I'm a hypothetical founder. I'm trying to choose between LLC and C Corp, and I want to really understand how important it actually is to factor in 1202 small business gain exclusion potential with a C Corp versus an LLC. Darden, what are your thoughts on that?
Yeah, that's actually the biggest benefit of being a C corporation as far as the startup company is concerned. However, to be able to realize that benefit, you have to actually sell your C Corp stock, right? Not the assets of the business, but the stock. And Steve alluded to something earlier on this chat that, buyers typically are wary of purchasing stock. They much prefer to buy assets from a corporation, because if they buy the stock, number one, they do not get to step up the basis of the assets they purchase unless they meet certain other qualifications that can make a special election to do so. And the liability associated with the company and its stock also transitions over to the buyer. So for that reason, it's actually somewhat difficult to sell C Corp stock in this world, or in the startup arena. And, for that reason, 1202 kind of falls by the wayside for a lot of companies. If you're fortunate to be one that will find a buyer that is willing to buy your C corporation stock, then that's a fantastic win for you. The problem is you can't control who's going to buy your company. You can't force somebody to buy your C corp stock. So you're kind of rolling the dice, hoping that you're going to be able to find a buyer that is willing to buy your C corp stock. And if you do, great. But if you don't, then you kind of, trapped yourself as a C corp and ended up missing out on one of the biggest benefits that there is out there. And me personally, have I seen 1202 used? Absolutely. I actually worked with a company out of Charlottesville that was an LLC for a long time, converted to a C corporation, held that C corp stock from the date of conversion for at least another 5 years, then went to market and was actually able to find a PE fund to buy their stock. And the founders were able to avoid a ton of gain on the sale of their C Corp stock. But that just goes to show you that you don't need to be a C Corp from the start. You can be an LLC, convert to a C, and still get 1202 treatment. You just have to make sure you follow the timeline appropriately.
Right. Mm-hmm. Cool. Next
question. Just gonna reinforce that it reminds me a little bit of the availability of angel tax credits at the state level. So investors do get enthusiastic about 1202 and angel tax credits. That's sort of the investors' cocktail party talk. 1202 to me is like a lot of issues. You don't want one factor to wag the entity planning, entity choice dog, right? So it's one of 15 factors in making this decision. So it's never, I don't think it's ever the sole driver in the choice of entity.
Cool. Next question, primarily for Steve, but maybe Darden, you've experienced this as well. I want to circle back to your comments, Steve, about an investor or a set of investors complaining about receiving K-1s. Again, hypothetical founder hat on. If I had a prospective investor who wasn't very sophisticated, is this a relevant or pertinent thing to think about when deciding an LLC versus a C Corp? Specifically being you don't want to issue K-1s to someone that maybe has never received a K-1 in their life. That's probably unrealistic for high net worth individuals, but what are your thoughts on that? And maybe specifically what happened in your example, and does making estimated payments to help offset potential phantom income resolve that in your experience, or is it still an issue to investors?
I think it's just it's a hassle factor issue for investors. I'll make a joke and say that maybe the definition of an accredited investor under the securities law, somebody that you can legally sell stock to without registering the stock, should be a person that has received a K-1. I mean, certainly a sophisticated investor has seen a K-1 and understands it. So angels are sophisticated people. They're wealthy either because they're smart and got wealthy on their own, or they've inherited money, and but they're sophisticated about tax stuff, if you will. So in my experience, paying estimated taxes is not that relevant. Most of our early stage clients are throwing off losses, so the K1s will reflect losses, but it is sort of a hassle factor. Perhaps my experience is that the angels in Charlottesville, and you know who they are, many of them, they're used to getting K1s, they put up with it, and they won't elect not to invest in your company just because they're going to get a K1. If they like the business, if they like you as a CEO, they're going to invest even though you're an LLC and they're going to get a K1. What they do get a little frustrated about is extensions, having to extend their own tax return because the accountant is late with your company's tax return. So we do get that kind of pushback and feedback that if your friendly angel investor can't file her 1040 because they're waiting on your company to do the tax return, that can be a problem with the relationship. So long-winded way of saying it just doesn't, I've never had investors complain to a client about being an LLC or about getting K1s. And I mentioned this earlier, the only client that I had convert to a C Corp as a result of the so-called tax rate changes in the 17 Act, they did it because as the company, they had tired of making tax distributions because they were profitable in doing the K1s. So angel investors are pretty cool about K1s in my experience. But as soon as I say that, I sense that there could be a huge backlash of folks that'll be listening to this and have different experience. Darden?
Yeah, I want to definitely chime in on this topic. And from my perspective, it's all about timing, not about the fact that they're getting a K1 or having to incorporate a K1 into their return at all. Anybody who's an accredited investor has a CPA or a tax preparer that knows well and good how to handle that K1. It's very rare that you're going to have an accredited investor who's preparing their own tax return, who's then getting a K1 and doesn't know how to handle it. So the real issue here is more about timing. And what I want to ask is that we all share a little bit of responsibility here, because a lot of this comes down to when the companies can actually get the information to the CPAs to prepare the tax return. You know, if we don't get information from the companies until the end of February or March even, you know, we're not going to be able to turn around those K1s, but tax return and K1s, but so fast. So yes, that very well may cause investors to have to file an extension and not file their personal returns by April 15th. But if a company can get their financial information to their CPAs in January, by the end of January, then there should absolutely be no concern whatsoever of those K1s getting out by April 15th, unless there's super complex allocation provisions in the operating agreement, or you're dealing with 704B revaluations or something else that's just at the complete deep end of the pool. But in typical startup fashion, if you get the information in the door early enough, we will make sure that your investors get their K1s.
Cool. Last question, and this is primarily for Darden, or maybe it can be for Steve as well. I'll make it open for both. Again, I'm a hypothetical founder. I'm 50 years old, and for the past 20 years, I've been using X CPA. What are the questions I should be asking them to see if they're properly qualified to prepare my business's 1065 partnership tax returns?
The first thing I would ask them is, have you read my operating agreement? And the second thing would be, do you understand the provisions in my operating agreement? And perhaps ask for some simple examples or simple explanations of what the operating agreement would say the outcome should be. If you ask those simple questions and you get an answer that just says, well, activity will be allocated based on ownership percentages, pretty sure that it might be time to look for someone else. Yes, ownership percentages do drive a lot of the boat, but when you're dealing with partnerships and the way that allocation provisions are drafted nowadays, the vast majority of startup companies I'm seeing are moving towards target capital account allocation methodology, or there's some sort of preferred return, or there are different classes of units that have different rights or get different liquidation preferences or things like that. So when you allocate just based on ownership, based on the sheer number of units that a person holds, you are not abiding by the operating agreement, and you are not allocating activity the way that it's supposed to be done based on what the economic agreed upon deal was. So if you ask a line of questioning such as this to your present preparer, and they're not able to give you a straight answer, or they just default back to ownership percentages, then I would think it'd be time to, at least consider your options.
Cool.
I would, Justin, I would also just add that whether you're an LLC or a C Corp, I know some great sole practitioners who really get the job done. But my question would be, and I can sort of ask this for the client as the lawyer, do you have the bandwidth to do state and local tax returns for multiple states? Do you understand not only an LLC operating agreement, but if I'm a C Corp, can I get a second opinion from you on things like 409A, stock option taxation, preferred stock dividends, convertible notes? How does that work? Because one of the things I've learned from Justin and Steve when I work with them as lawyers, they always want to know, they always tell me to get a second opinion from the CPA. And when I tell my clients or ask my clients to get a second opinion from Darden or CPA, it's not a lack of confidence on my part. It's it's an indication that, first of all, it's a respect for Darden and the CPAs, but it's also sort of out of fear. I don't want to get a phone call in April when Darden's doing a return, and we made a decision in November, and he had a different perspective on something that we did. So whether you're forming a company or raising money, if you can get input from your accountant and your lawyer at the time you make the decision, you can hold us accountable for the decision that you make later, because you can say, well, Steve, Darden, Justin, you did know about it because we talked about it, and Darden disagreed, Steve and Justin called the shots. So I want an accountant that I can come to if I'm a founder and say, here's the legal advice, here are the legal documents, what's your perspective on the tax and accounting and financial aspects of what Steve or Justin are recommending?
Cool. So corollary to that, Steve, if I'm a founder and I'm trying to find the right attorney, what questions should I be asking that attorney to gain the confidence that they are the right counsel for me?
Right. I think this will be music to our entrepreneur and CEOs' ears, and it'll make you and me look more honest than lawyers typically look. That was a half joke, I guess. How do you charge for your services, and what could it cost me? We do a lot of alternative fee arrangements. We spend a lot of free time like this, frankly. But we'll do one-on-one. I worked with a local, very exciting startup in Charlottesville this past year. I think I had 4 or 5 meetings, never charged and never got hired. And I'm not sorry that I did that, but it's interesting. Life insurance folks and stockbrokers are jealous of the 3 of us because they think we charge for every breath, every minute, every page of the document. And it's just not true. So find a lawyer who you like, that you can spend some time with. Find a lawyer who's not uncomfortable and whose eyes don't dart when you ask about fees and how much might this cost. My answer is usually, no, Justin's answer is, if you have to ask, I'm too expensive for you. No, I'm just kidding. That's not Justin's answer. But number 1, transparency. Do I like this person? Number 2, what's your business experience even before we get to legal issues? Do you have experience with companies like mine? I'm a solar energy developer. I'm a biotech company. I'm a company that has a software as a service tech. I really believe industry knowledge matters. Darden's firm has a lot of depth, as does Darden, in real estate development. As an example, Darden and I both also do a lot of technology company work. My firm does a lot of food industry work. So what do you know about my industry? What's your experience with startups? I'm very comfortable telling people in our market that Justin Ritter has a lot of experience with startup companies and entrepreneurs. And more important, he's honest and he's got integrity and he likes to do a good job for people. So beyond that, when we're pitching business for bigger companies, it's more important that they hear about what we've done in the past, the kinds of deals I've worked on. I will say this for the 3 of us, that this is kind of a pitch. I also think it's important to ask your lawyer prospect, have you worked for sellers and buyers? Have you worked for companies that are raising capital and for VC investors? Because to me, as a CEO or a founder, show me a lawyer that works with a lot of startups. But if you show me one like Steve, who's worked for buyers and sellers, for investors and founders for 20, 30 years, one of the things that the 3 people on this session really bring to bear is we've seen close to every possible scenario. And so one thing we know about planning without a crystal ball is that you don't want to be set in one box. And every deal and every company and every founder, their business model and their personal dreams are different. So find a professional who's not only got the bandwidth to be responsible, the pedigree and the experience to give you the right answers, but a professional who's flexible and can tailor their advice to you and make you feel unique, because you are. And when I give advice, it's 1 part tax, 1 part legal, and 1 part what makes my client, the CEO, founder, and her board tick. What are their objectives and goals? And I'll say this, because I work with you guys. Darden and Justin bring the firepower and the capability to the table. Work with people that you can bear to spend time with. It's so important. And if I don't want to spend time with a client prospect, I move on. So it's a 2-way street in relationship, mutual trust and respect.
I want to just chime in on one piggyback off of something Steve just said a second ago. You mentioned the tax part of the consultative side that you provide, and I think that is critical. And I know that I'm a little biased coming from the CPA side of the table, but I run into multiple instances where a great lawyer was involved, and their contract knowledge and their M&A knowledge was unquestioned, but their tax depth wasn't exactly where it should be, or where it needed to be for that specific deal. So, and granted, this was a pretty complex deal, but the point is that you need to make sure that legal counsel also at least has enough understanding of the tax ramifications of the deal and the economics of the deal to be able to put it into writing, to write it into your operating agreement, because it's that language that's really going to dictate what ultimately happens. So if something is intended one way but it's written another, you could end up in a really ugly situation down the road.
And that concludes part 1 of session 2. Please feel free to take a break, hit pause, and when you're ready, we'll return with part 2 of session 2, Start Me Up Right, How to Organize Your Business Entity. Hi, my name is Justin Ritter, and welcome back to the For the Founders series hosted by CBIC. Today we have an interesting little mini session that's a part of our session 2, with this session relating specifically to banking relationships and why you should establish them as soon as possible as a founder for a startup. And so with us today, we have Raichel, commercial banking lender for Wells Fargo, and Carolyn Burnett, business relationship manager, again for Wells Fargo. Hey, Joe. Hey, Carolyn.
Hey.
Hey, Justin.
So if I were a founder, why should I establish a business banking relationship at the very beginning of my company?
Well, Justin, I'd say, we see a lot of founders who come to us looking for a commercial banking relationship at the point that they're ready for their first bank loan. And so oftentimes when that's the case, there's no relationship or rapport already built. We don't have a good understanding of that business. And so often that can mean it takes a lot longer to find the best fit relationship for that customer within the bank, and then also then to assess and help them build in the services and the setup that they need. So really today, we really wanted to offer some best practices and tips for how founders can get a leg up on that process, and to build a valuable banking relationship for their business.
Cool.
Yeah, Justin, I would add to Carolyn's comments, the first step is finding a banker. And I would really emphasize a banker as opposed to a bank in particular. And so I think a lot of folks will go into a branch and seek some advice. But if you can get to a commercial banking team, I think that is optimal. And again, as Carolyn said, as early as possible. Also, you're going to have lots of advisors and lots of folks that that are going to be able to refer you to someone who could be a good banker for you. And so I, again, would urge people to begin that process sooner than later. And so let me build on a couple of things. I would add 2 more points to that as to a little bit more insight into why it's important and then what you're trying to get out of it. So number 1, you really are trying to bring that banker in and have them understand the business very deeply. And that's more difficult in the moment of a transaction. So the ideal building relationship is really more when you are going through the process and bringing them in and really helping them understand the business plan, where you're going and what your needs are going to be. Because if that banker understands that deeply, then they can include other people in the bank. And so I always say banking is a team sport. Your banker is going to be one point of contact, but they will have lots of resources, credit partners, treasury partners, other product partners that they can lean on. And those people really depend on the banker to have a really strong established relationship and a great knowledge of that business. And so often at Wells Fargo, we like to also introduce our clients to those people as well, so that they can have a broad institutional knowledge of what we do at Wells Fargo and the different players. And lastly, so that does lead to what I think is really most important when it comes to any type of relationship is trust, so that you can really understand each other and get to know what works best and have open dialogue and open communication, which leads to optimal decisions to manage your financial assets. That's really the ultimate goal, is help you succeed financially. And the only way you can do that is through strong relationships, really understanding each other, and having open and honest dialogue. And sometimes that dialogue is going to be not what everyone wants to hear, but sometimes that's the best thing, is when someone's giving you some tough truth that to act on.
And I'll jump in there too, and say, you know, okay, so we know it's important to go in and start early, but what does that mean, and how do you begin that mutual trust relationship with a commercial banking team? So I can go through what that has looked like when I've met with founders recently. So oftentimes they'll come to me either because they know me from other community places, or I'll get a referral from that retail bank employee who has had a nice conversation with that founder to know what they're doing and say, hey, I think you might need to be connected to our commercial team, if not now at some point. So it's always optimal to start that conversation right at the beginning, because we want to not only understand what your current best fit is, but what your future best fit is. And a lot of times, depending on your company, that may look like you have a very, very simple needs for 6 months, 12 months, 18 months. But then at the point when you start to accelerate, that need is going to come for more complexity very rapidly. And so what we want to do is sit down, and a lot of times that'll include our retail branch teams and our commercial banking teams, to all sit down together with the founder, talk about what they expect for their company. And of course that's going to change and adapt over time as the business grows. But we sit down, we understand what we can at that moment. And then we decide with the founder what is the optimal time frame in which we should meet back to continue to reassess. What's the current best fit, midpoint, longer term? And at that point, we can decide if there are kind of technological automation tools that we can use to help the company scale through treasury management or other resources that the bank has. We'll talk about those and kind of make a little timeline about when we think those might become relevant for the company. You don't want to wait until the structure is needed to build that structure within your banking relationship. So that's what that looks like a lot of times. And for me, it's really the reason why I love my work, because it's really gratifying to sit down with founders and help them walk through that planning and plan for the best success of their company.
Cool. Well, hey, two quick questions for y'all. First is, if you're a founder and you're looking to establish a business banking relationship and you're doing your due diligence and you're talking to several banks, what questions should the founder be asking the prospective bank and banker to really get comfortable making the pick that this prospective banker is the one I'm going to ultimately use?
I can jump in. I know depending on the industry that the company is in, you want to ask and find out from that bank if that's an industry that they have experience working with and what specialty groups they might have available, or resources or expertise within their team to help work within those specialty groups. Because a lot of times that can be a big differentiator in whether or not you get that know-how and those resources that you need before the point that you need them. And then I would also understand what's important to you as a founder. How often do you want to be able to see your banker or talk to your banker? And what kind of conversations do you want to be having? And ask the local team and find out from the bank in general if that's a service that they provide, if that's how they operate. Joe, anything else you would add?
Yeah. So again, I think the experience of that team is really important. I think you should think about and ask about how does the bank make decisions. I think a lot of times credit decisions are what people are most interested in, and how does that bank go about doing that? What are they going to be looking for? What does the credit process look like? And again, are those decisions ultimately made? I think that's very important. And I would add on that there are lots of specialties inside banks. Ask those questions. Ask, do you have a group that specifically caters to this industry or a specific product set? How does your treasury management platform work? Is it one that you have built, others have built? Those types of things. Just have a good understanding of what is the expertise of that particular bank and how do they make decisions And then I really like what Carolyn said about, what do you want out of that relationship? Is it going to be best work for you as a business owner, from how often you meet to how you communicate to how you exchange information? All those things are really critical and should be, if you can have that dialogue at the front end, I think that's really optimal.
Thank you. One follow-up to that. When you have founders seek your services, what are they typically asking? And a corollary to that, what are they not asking that they should be asking at the inception of a banking relationship?
Well, I think that it's less about what they're asking and about what they're not telling, if that makes sense. I think some founders have this idea of banking specifically as this is where I open my account and this is where I ask for a loan when I need it. And really, if you have a strong banking relationship, that's the transactional base level. That's not the entirety of the relationship. So we find a lot of founders coming in and saying, hey, what kind of checking account do you have and when can I get a loan? And they think that that's the box that we want to talk about, when really, like we had mentioned before, we really want to know, how did you get here? What is your expertise? What are your dreams for this company? Do you want to grow it and sell it? Do you want to grow it, stabilize, and then acquire other companies? What's your hiring plan? How do you plan to build the infrastructure for your operational, just the operational center of your company as you grow? What are the technologies and sciences or any portion of expertise that you have? How are all of those things connecting together to meet the goals of whatever this company is for you? So I think I would urge people to, when they're having these conversations with their bank, don't put your bank in a box of deposits and loans. Find a team that you trust enough to be able to have some really honest conversations, to really let them get to know you and what you want to do, because a lot of times it can be surprising, either through network resources, knowledge resources, or service resources, what a bank can provide for these founders.
Yeah, I think the thing I'd just add to that, Carolyn, probably summation is less transaction, less that specific thing, and more broad relationship. Bring them in. Your banker can provide all kind of thoughts, guidance more broadly. And again, you're developing a relationship with your banker. So think in terms of that relationship and as a trusted advisor, again, as opposed to, opening that account or apply for that credit card or apply for that loan.
Okay. And given the unique nature of Charlottesville and the various startups that are here, like what examples of packages, like let's say you have a biotech founder that comes to you versus say just a regular high technology non-biotech startup. Like what are some of the packages that you're seeing that you're offering folks?
Well, we tend to be really custom. We don't have a set package that we would offer to any specific company. We have specialty teams at Wells Fargo that deal with a lot of those type industries, both on the regular tech side and life sciences side. So what we would do is, in that initial meeting that we were describing, we would really be reaching out to those folks to be part of that initial conversation with the founder. They provide kind of a lot of times some expertise, some tips for the founders a lot of times. And then depending on the kind of anticipated growth pattern of the company, we would decide where the relationship team would be based out of. And then we use those specialty resources kind of as complementary tools, or sometimes we'll send it right to that specialty team, depending on the needs of the customer. So I would say, the main things that we look at, though, for most startup companies are, when is the point that the complexity of the operational transactions that they're going to have? How many payments are you going to have coming in? How many payments are you going to have going out? How many suppliers are you going to have? And how are you going to manage your cash flow in general? We spend a lot of time talking about those things to help understand how quickly the complexity is going to ramp up, and if any automation, technological automation might be able to be helpful there. That's a lot of times where we'll start. But in so many cases, there are other branches to that tree that come up in conversation.
Yeah, the only thing I'd add to that is, I just think of the initial conversation, or Carolyn and I are what we call generalist. So we cover a broad area, and one of the benefits we have is the resources of those that have that specifically work in specific industries, either exclusively serving those or are as thought leaders. And so that maybe goes back to a question, Justin, you asked before, is when you're looking for a bank, you might want to inquire, how deeply they go into those verticals and how much they understand about those things and how valuable that would be to you. Again, some people that would be enormously valuable, others it may not be. So, that goes back to the questioning, but I think it's almost generalist to very specialty based on the needs of the client. Thank
you. So, Carolyn and maybe Joe too, could you elaborate on these treasury management services? What exactly does that entail?
Treasury management is I would say a broad banking industry term to describe technology that helps with the movement of money through the bank, and that broad umbrella could refer to a lot of things, very basic things like wires, ACHs, to much more complex things like almost fractional support for fund processing, kind of invoice outsourcing or payment receivables outsourcing, and those products and services kind of change and grow over time. But those I would say would be the most basic subsets of that. Did I miss anything, Joe?
Yeah, only thing I would add to that is visibility into your accounts and understanding how that all works and having a platform that you can see it that's technologically user friendly. And then the other thing is fraud is such an important part of everything we do. We can't stress it enough how often that becomes a real challenge for businesses, and it's more prevalent than we would like it to be. So those are really important aspects of as we understand a business. We want to make sure we're getting them ahead of fraudulent situations. We're having a seminar just today for our clients on fraud associated with the coronavirus and things that we're seeing. And so we're availing to our clients a webinar this afternoon that's going to talk specifically about that.
Cool. One follow-up to treasury management services. So it sounds like it can be a wide range of services. Would you say it's for more mechanical functions of a startup, the processing, the ACHs and all that, or is there some discretion going on where there's recommendations from folks at, say, Wells Fargo that are like, this is your cash flow, you need to reduce your expenses here? Is this essentially a fractional CFO potential?
I wouldn't call it a fractional CFO. Definitely, some of our more complex services could, look a lot like fractional support for a certain product. Like you can outsource your accounts payable processing through these treasury management package. You could outsource your invoice processing, your accounts receivable processing that basically would allow you to take what in many cases are more manual processes to key everything in and instead send it in batches and have somebody else actually send out the individual payments or receive and reconcile those kind of things. So that's one part of what it could be. I would say that, most startups don't really need a lot of treasury management services at the very beginning. So again, this goes back to really what we're looking at in the broad picture today is you need to have somebody that you can talk to that can look at what you're doing now and say, okay, this is what's appropriate for you at this moment. Maybe you just need a very basic account with no extras that will just allow you to send money every once in a while and receive funds in every once in a while. Okay, we get that. But at the moment which you go to market with your product and maybe you're going to scale very quickly, that very simple 1-bedroom apartment structure isn't going to be appropriate anymore. And if you wait until the moment that you're bursting at the seams within that structure to figure out that next thing that's going to help you operate efficiently, or you just hire more people to do it manually to pick up all that heavy load that's coming on, it's too late, it's inefficient, and it's not going to be your best path, right? So if you're talking with a team that can look ahead and say, well, what is that inflection point where you're going to begin to accelerate your growth? And at that point, we might recommend X, Y, and Z. Here's a kind of a cost benefit analysis for you about what that would look like. And oftentimes we'll advise clients and say, when you get up to this level of transactions, we think this would be appropriate. When you cross this line, this is something you're going to want to think about. But it's important we start to talk about it several steps in advance so that founders have an opportunity to understand what that is, ask questions, and then we talk as we approach that point in their graph of where they're going to need that. That's where we begin to talk about it. So it's a very customized approach that really looks to where the founders are in all the stages of their life cycle.
Yeah, one other point I'd just add to that, Carolyn, is there's also the ability for us to compare to other businesses that are similar to that business. And so, we have data points across the country of clients that then we can say, hey, clients at this level have done these things, and this is how these financial metrics look compared to others in your industry, in your specific business. So that's sometimes helpful for folks to go, okay, that's interesting to know. And our data point is pretty broad because of the size of our institution, so that we can provide a broad view of what that looks like.
Very cool. Well, do y'all have anything else that you'd like to mention regarding establishing business relationships at the beginning for founders?
No, I just say, build those relationships and don't wait. Do it early.
Yeah.
Agreed.
From my perspective, I see too many times founders just use their bank where they personally bank without giving it much thought. And for me at least, I've learned a lot, and thank you both. Truly.
Wonderful. Thank you so much. We really appreciate the opportunity to be part of this series.
Yeah. Thank you, Justin.
Thank you. And that concludes part 2 of session 2. Thank you for listening. Thank you for watching. Quick update and FYI, on May 12th at 2 p.m., CBIC is going to host a live webinar to answer your questions related to the topics that were discussed in this session 2. I want to give a quick shout out and thank you to our sponsors to help make For the Founders series possible. Thank you, Wells Fargo. Thank you, Keiter. Thank you, McGuireWoods, for your contributions to this session 2, as well as your overall sponsorship. And thank you to our other sponsors who did not participate in this session 2, specifically Fahrenheit Advisors, the Catalyst Program, CSH Development, and Leidos. Thank you all, and see you at session 3.